I mean, the whole thing is an absolute mess. The underlying point is there is so much zombie debt within the private sector that higher interest rates, which are inevitable now, are going to drive the whole economy under.
This is Kaiser Johnson with Liberty and Finance. With premiums on US 90% silver constitutional coinage at multi-year lows, this may be an ideal time to swap silver bars or rounds for 90% silver and gain all the benefits of US Mint lineage, legal tender status, non-reportability, and fractional utility. So right now we're running a special where we will swap any of your silver bars or rounds for 90% constitutional silver at a minimal premium difference. Call us for details.
Welcome back to Liberty and Finance. We're always delighted to have this widely followed returning guest. Alasdair Macleod is a former bank director, a former head of research at a major gold dealership, and he's also now the owner and founder of a Substack account. He joins us this Thursday, March 13th, 2025. Alasdair, thank you for joining us again here on Liberty and Finance.
That's my pleasure.
There were two articles of the many that you've written most recently that really grabbed my attention. One is titled, Central Banks Are Going Bust. We want to talk about that. You also wrote another one called, Is the Credit Bubble Bursting? Both of those sound fairly dramatic. The first one, to some viewers in the cheap seats, would seem like almost an oxymoron. They say, how can central banks possibly be going bust? Because they're tied at the hip with treasuries, and treasuries can always print more credit by just a stroke of a key. So therefore, they can never go bust. They could just create more credit out of thin air. And maybe that's tied to your second one about the credit bubble bursting, but we'll get there when we get there. But first of all, what do you mean by central banks are going bust, and how can we tell?
Well, if you look at it purely from the point of view of any trading entity, if your equity is wiped out by losses, mark-to-market losses, if you like, or even trading losses, then you are trading fraudulently, and indeed is a criminal offence in most countries to do so. But that is the position which all central banks are in today. Of course, as you imply, people don't worry about this terribly because they say, well, they can always print more currency. Well, that is obviously true, and it's been particularly true if you look at the situation of the Bank of Japan, whose equity is so far underwater. I mean, because the Bank of Japan owns roughly 60% of Japan's debt, the JGB market. This is enormous. And so the equity, last time I calculated, the figures are not that material, but it was something like 40,000 times underwater. The equity was so insignificant compared with the losses. The second thing people say is, well, there is always the other backstop, and that is that central banks are owned by governments. They're a government agency, and so they are backed by the, if you like, the tax revenues of government, ultimately. Now, that as an argument is pretty specious, because if you look at certainly the US, you look at most of the European countries, so we'll take it as the EU as a whole, the UK, and also Japan, these countries, these nations, these units are in debt traps. In other words, their economies are not growing sufficiently to pay down the debt, or if you like, to cover even the interest on the debt. Now, under those circumstances, this is called a debt trap. And inevitably what happens is that the lenders, if you like, the creditors, demand a higher interest rate in return for this extra risk. Now, this is particularly apposite at the moment, because if you look at the US economy, it's stalling. It is actually, on any sensible calculation, it is actually going backwards. The private sector is contracting. Now, the reason I get there is quite simple. And this is on official figures. The Congressional Budget Office's own figures say that the US economy is growing at 4.5% in this fiscal year, but the budget deficit is 6.5%. Take 6.5% away from 4.5%, and so you've got a private sector which is contracting by 2%. Now, that's in nominal terms. As well as that, but if you take the official rate of inflation expected by the CBO at 2.9%, you're looking at a contraction of 5%. Now, we can calculate it for this year. You can also do the same calculation for the previous year and the year before that and the year before that. And of course, the COVID year was a real economic disaster for the private sector. So I think what's happening is people are beginning to understand that this is the problem. So in effect, you've got a contracting private sector GDP, which is meant to support this increasing level of government debt, which in the US case is increasing by roughly $2 trillion a year. So where is the revenue, if you like, to back all this? The revenue isn't there. So you've got, on the one hand, you've got the revenue diminishing. You've got that debt to GDP ratio. This is, this works out at the GDP actually contracting, if you look at it, taking that distortion of extra government inflation pushed into the GDP. Consequently, the idea that there is the backing for central banks is just not true. The ultimate backing isn't there. And we have to tie this in with the credit bubble. Most people don't really understand they're in a credit bubble, but you've only got to look at the other side of credit. Look at debt. Oh, yes, we're in a debt bubble. We all know that. So if we're in a debt bubble, we are in a credit bubble. And that credit bubble is the biggest ever seen in the history of the world. So that is now beginning to topple over. And we see this with stock markets in particular. We see it with cryptos like Bitcoin. We've also got, which is very alarming, I think, a combination of events which we saw in 1929 to 1932. That is to say, the unwinding of the credit bubble of the Roaring Twenties, which was brought about by Benjamin Strong at the Fed, who was if you like, a monetary expansionist. And at the same time, you had the Smoot-Hawley Tariff Act coming in, which increased tariffs by an average of 20%. And some saying, there were cases where it was more than that. And what happened? You had other nations, I think something like 67 trading nations at that time responded by increasing their tariffs against the US. So you had this tit-for-tat thing, which suddenly, along with the credit bubble bursting, just threw the whole world into a depression, and particularly America, where some 9,000 banks went bust. This time round, of course, we can't allow banks to go bust. And, they're not small two-branch banks, which, was sort of typical in America in the late 1920s and into the 30s. But, the Fed's going to have a problem. How can it rescue? How can it underwrite the commercial banking system if it is deeply in negative equity and it is becoming apparent to foreign holders of the dollars that they're not getting compensation for the risk of holding those dollars, so they are selling dollars for gold, which is actually what we see at the moment. As far as the Fed is concerned, the only result, if you like, of their trying to rescue the entire financial system in America will be to drive the dollar down. Because part of that is going to be suppression of interest rates, which will be rising. So, this is a situation which I think people are not really aware of. I mean, for a start, they're not really aware. They may just be becoming aware, if you like, that there's a credit bubble bursting. But the vast majority of investors aren't there yet. And I think the second thing is that this sort of comforting thought that, the central banks can always print their way out of trouble and, negative equity doesn't matter in a case of a central bank, and anyway, the government's going to rescue them or whatever, you backstop the whole thing. This, I'm afraid, is not the case. It cannot happen. So we need to understand this, and I think the earlier we understand this, the better for us.
Several things emerged to me from what you were just describing. First of all, the notion that the ultimate backstop of a failing balance sheet of the central bank is the ability of the government to tax its people and its economy. But if you've got a shrinking physical economy and it doesn't help to count, as you point out, it doesn't help to count as part of the GDP, the false injection, the artificial injection of government funding into to prop up and make it look like there's activity in the economy when it's not really productive economy. You can only tax the productive part. So it's like a farmer. I mean, the analogy comes to me of a farmer saying, "Don't worry, I know I owe you a lot of money, but I can always pick some more fruit off my tree. But the tree is dying at the time, or the tree is shrinking away, and you can't keep picking more and more fruit from a dying tree." The other was you mentioned about the mirror image of the 1929 that we see playing out here, the rhyming of this. And you have warned us before about the pitfalls of getting into trade protectionism and tariff wars. And yet you've got Trump as the new head of state here in the U.S. pulling out, on a daily or hourly basis, new and changing tariffs against all wide variety of trading partners. And when pressed on this, are you pushing us into a recession? He doesn't like to use the R word, so he says, well, we're going into a transition time, but that's necessary to clean house and get our house in order. So this transition time sounds eerily reminiscent of what you're talking about after the Smoot-Hawley Act of escalating tariff wars between countries that are increasingly desperate because they're all suffering. All of their private economies are shrinking, and you're going into a global recession. The other thing is, you mentioned this whole thing about happy days are here again, roaring 20s, etc. As long as everyone's willing to play along in the full faith and credit of the U.S. But here you have foreign holders of U.S. treasuries who are in some ways more open-eyed and less sleepwalking than perhaps the Americans are. And you've warned us about that month after month, saying it's the domestic holders of debt that are the last, or the currency, that are the last to realize that they're playing along with funny money, when the rest of the world, the foreign holders, have already wakened up, have already protected themselves by divesting of those positions. So any of those points that you want to expand on, because I think they're absolutely necessary for people to get a grasp on who are among the American population and not yet perhaps fully perceiving this.
Yeah, I mean, what you say is absolutely right. But I think there is an additional point, and that is that foreign ownership of U.S. financial assets is now more concentrated on equities than on U.S. treasuries. At the last count, we were looking at something like 15 trillion of portfolio holdings in equities. And, as the equity markets turn south, they're going to start liquidating that. So you can see that there's a potential avalanche of selling going to develop there. It's a combination of feeling that this is the case and also understanding the real background to it. Drives me to the conclusion that this is something that could actually happen very, very quickly.
Did that come into play in the 1929 model that we're making an analogy here to, as far as foreign selling of U.S. stock markets as well?
To a lesser extent, I believe. I don't actually have the statistics. All we know is that overseas investors were caught up in the crash. But I think Winston Churchill lost money in that crash, believe it or not. John Maynard Keynes lost money in that crash as well as other economists like Fisher, who at the time stated that he thought that that equities were at a new high plateau, or words to that effect. But I don't think it's not like today, because the difference between then and now is that instead of gold acting as the international reserve money, we've got the dollar acting as the international reserve currency. And so foreign exposure to the dollar is far, far larger than it ever was in previous times. And on top of that, American brokers have been very, very successful in promoting US stocks around Europe, around the rest of the world, so that they're very much owned, if you like. The typical foreign investment, let's say for a European investment manager, the heaviest weighting is always in US equities. So, and you've got the comfort, if you like, as a manager, knowing that the dollar, if you like, is, you don't have effectively currency risk, in the sense that you're investing in an asset which is denominated in the reserve currency, if you see what I mean. It's very, very different for an investment manager in Europe, say, investing in the Japanese stock market, where the Japanese yen, whatever its merits may or may not be, is not the reserve currency. So it's built up in huge, huge quantities. And of course, when you get a bull market, everybody just increases their positions because, it's as easy as anything to make money, and it's going up, so you've got to buy it. And the foreigners have been sucked in just the same as US nationals have. But it is a credit bubble. And as I say, the best way to get a grasp of how serious it is look at the debt bubble. And if you've now got a global economy that's contracting, partly because the credit bubble is too long in the tooth to support the underlying economies, and partly because of new US tariff policies, you can see that the financial destruction could be absolutely enormous, and it's inevitable. And the question then becomes, how far does it go down, partly, and what the hell's the Fed going to do about it? The Fed, I think, has a clear mandate under these circumstances to try and support markets in an effort to support the economy. And that means, as far as the Fed is concerned, that they've got to cut interest rates. But the exchange rate will demand a rise in interest rates. So, I mean, they can make the Fed funds rate zero, but, they do that. The yield, let's say, on a 30-year treasury could be 15, 20% quite easily. A very steep positive yield curve. Why? Because of the risk of holding US debt.
In the past, you've warned us that it's domestic holders that realize their currency's in trouble last, that the foreigners wake up first. It certainly seems with the phenomenon of the formation of the BRICS plus alliance of international countries that are all gathering together to come up with a non-dollar means of settling international trade, etc., that there's an awakening there. And there have been very compelling speeches by Putin, by heads of state from Africa and elsewhere saying, look, folks, the writing is on the wall. You got to make your future plans away from the dollar, away from the SWIFT system, etc., because it's being used to punish you and it's not as stable and so on. Is it the case that they're simply being pragmatic and they're waking up first? Or is there, in your view, a direct campaign to prevent the news from getting out to the local domestic retail investors and so on in the U.S. that of the gravity of this situation that the other rest of the world, the BRICS Plus, et cetera, are all well aware of, and they're all talking about it, but it's not being spoken about the way it should be on the mainstream U.S. financial press? Is that just because that's the way the world works, or is it because that's against the perceived best interests of the state? It's not in the interest of the state to have people losing faith in their own currency and banking system, et cetera?
Well, it's quite hard to separate out the two, I think. I have no doubt that, in America, there is this sort of view. It's a very sort of domestic view that the dollar is, that's what we account in. And nothing else really matters. And the idea that, the Fed, if you like, should try and manage things in the light of the effect on the dollar is wholly alien, I think, to individuals in America. they don't understand, I'm sure this is right, they don't understand the dynamics that drive the dollar against other currencies, except to the extent that so long as the dollar is the numero uno of currencies, then what are we going to worry about? So I think it's quite simple. As far as the BRICS countries are concerned, they're in a very difficult position because America is extremely powerful. They owe money in dollars where they owe money, or currency rather, and consequently, they don't want to upset their bankers. So they're not in the business of running around and telling everybody how awful the American government is and how they're destroying their currency and all the rest of it, and we're going to sell it off. No, they would rather keep quiet at things. Now, a very good example of this is India. India does a huge amount of trade with the West, and it's not in its interest to rock the boat on currencies at all. And it's only recently, actually, that India has sort of decided to start protecting herself by accumulating gold reserves. And, they haven't finished doing that. I mean, it's quite clear to me that they need to get their reserve position up even further. The reason I think that India's got left behind is that it's gone through a period of Keynesianism, informed by us because we've been responsible for the appointment of governors of the Reserve Bank of India. That's something which the Bank of England has always been consulted on. In other words, it's someone who we approve of, or the Bank of England approves of, ends up being governor. And by definition, that's someone who follows the same sort of economics, if you like, that the Bank of England and the UK Treasury follows, which is Keynesian. So, or neo-Keynesian, if you want to put it that way. So, countries like that, I do think have a problem. They know that the Western system is dying on its feet, but they can't sort of just break away from it completely. I think that this, if you like, feeds into the problem that China has, because there is absolutely no doubt that China has accumulated huge amounts of gold off balance sheet. And not only that, but she's encouraged her citizens to accumulate gold as well, which they have to the tune of something like 27,000 tons. These are huge numbers. Not very much on a per capita basis, but huge numbers nonetheless. And as far as the Chinese are concerned, I think they know that at some stage they're going to have to protect their currency by putting it on a gold standard. But they don't want to do that too soon, because if they do that, they will destroy the Western financial system, because immediately everybody in BRICS will go and do the same thing if they're able to, or they will try and link themselves to the Chinese yuan, again, to protect themselves against the accumulation of follies that we've perpetrated on ourselves and therefore on everybody else. So the situation, I think, is actually quite delicate. And this is one of the reasons why I think the timing, if you like, of the collapse of the currencies could be, a bit closer than we think, rather than a long, drawn-out procedure. I mean, we've seen the purchasing power of our currencies decline over, huge amounts over long periods of time. I mean, I would say if you look at the relationship between the pound and the sovereign, I mean, originally £1 was one sovereign, and you could exchange a paper pound for one gold sovereign. There are now 550 paper pounds for one sovereign. Now, that is a huge, great loss of purchasing power for the sovereign, for the pound. And other nations, have had exactly the same experience. I mean, if you look at the way in which the purchasing power of the dollar has gone down since it was 35 to the ounce, it's now close to 3,000. Mm-hmm. You've got, the yen has gone way down. The euro and its previous constituents has gone way down as well. I think that's around about 1% of where it was. So, these losses are now likely to accelerate from here, which I think is really quite catastrophic.
You've spoken with us in the past about the necessity of governments, funds, individuals, anyone who's shepherding a nest egg of value to protect themselves. You've spoken to groups. You get invited as a guest speaker to address groups all the way up to nations to discuss this. What is the core message that you deliver to those audiences, and how do you go about framing that so that they can hear it and take appropriate action? And I'll boil that down to why we're here today, trying to bring this message to our individual viewers and subscribers as well.
Well, it depends on the audience. Where I've been invited into a central bank, I don't actually say, get the hell out of credit, which is what I would basically say to an audience, if you like, of investors, of individuals. But really, I mean, the answer really is that if you agree with me that it looks like credit is going to decline in its terms of its purchasing power at an accelerated rate, which, if you like, conventionally we would say inflation is going to pick up again, then you really want to get into something which is stable. And of course, money, in terms of its purchasing power, by which I mean gold, has been stable over millennia and will continue to be so. I think gold at the moment is beginning to discount some of the future collapse of the purchasing power of currencies. But you would expect that at a time like this. And this is certainly reflected in the fact that gold is leading by quite a margin the rise in commodities, and particularly metals. So if you look at, copper has begun to move higher, for example. But if you look at many other commodities, the sort of commodity complex is only just sort of beginning to turn round and is beginning to look sort of interesting in investment terms, as it were. But the fact that gold is so far ahead, I think, is a clear indication that is the direction in which everything is going to go, which, of course, reflects the fall in the purchasing power of currencies. That's really all that's happening. When you see copper rise, when you see nickel rise, and all the rest of it, and silver as well, it's loss of purchasing power of the currencies being reflected in those commodities, not necessarily demand for those commodities. And I think this is the point which analysts thinking in terms of constant purchasing power for dollars, because they account in dollars or sterling or whatever it might be, this is a point they all miss. They don't understand that actually what's happening is it's not commodities going up, it's the currencies going down. And that's going to be the major driver, I think, for commodity values in the coming years.
You've talked to us for some time about banking risk as well. For people who have large dollar-denominated deposits in banking institutions, there's a double whammy of risk. One is the in-our-face accelerating destruction of purchasing power of the dollar. And you're saying to us that as the Feds act to respond to a increasingly obvious credit crisis, that their options are limited, and they will opt in terms of further destruction of the currency to try to save the system, the banks. So that's there's a twofold risk that people are facing who are keeping large deposits in the bank. One is the immediate and ongoing destruction of their purchasing power, even if their bank balances remain stable nominally. They just won't purchase as much. The buck ain't worth what it used to be, and it won't buy as much next year as it does this year. The second is the actual banking system stability. We had Janet Yellen in testimony before Congress following the bailouts of major depositors who had way higher deposits beyond the FDIC insured limits in Silicon Valley Bank, Signature Bank, et cetera, back in first quarter of 23, who said to Congress, well, we had to do that because we deemed that there was a systemic risk. So there she said the quiet part out loud, that had we let nature take its course on these banks, that it might have pulled down the system. It could be a systemic risk to the banking system. Do you believe, based on your analysis, and you've done a lot of it, of the leveraging of all the various banks, that's no more risky than it was over the past several years? Has that risk gotten any less? Or has it become just clear to you that the central banks will opt to protect the banks and destroy the currency because those are the two options that they have?
Yeah, I think that the two separate things to consider here. I mean, what we were talking about bailing out the large depositors along with the small depositors and all the rest of it is really we're bailing out rather than bailing in. After the Lehman crisis, the G20 decided that they didn't want bad behavior by bankers for them to be bailed out by the public. So they'd have to be bailed in by their own bondholders. That would be an absolute disaster. I mean, it's the most stupid thing you can imagine, but it's typical, if you like, of the demands placed on politicians from the electorate, or at least as they perceive it. Of course, I mean, nobody in that side really understands what banking is about. I think the bail-in thing, hopefully we can dismiss it. I just hope that in a wide global financial crisis, no individual banking authority decides to try the bail-in route, because that would be disastrous. And, the disaster would be infectious, I think, across the global system. So let us just hope that doesn't happen. So if we assume that doesn't happen, then you will find that central banks will always do their best to ensure the integrity of the commercial banking system. The second point about it is that if you look at bank balance sheets, I don't think they have grown that much over the last sort of 5 or 6 years. This, I think, is important to understand because, while they haven't grown so much, what has happened is that the amount of lending risk has actually increased. What banks have been doing is they've been trying to duck this risk by going away from lending to the private sector, particularly small and medium-sized businesses, and lending short-term to the government, which is why we've had this increase in T-bill issuance, if you like. Duration risk is something that banks, it's not natural to banks anyway to buy into duration risk. I mean, they've got depositors who can take their money out on demand. They don't want to invest in something which, let's say, has a 5-year or 10-year maturity. So, that sort of aspect, is something which, bankers best avoid. And we saw this, in 2023 when a few regional banks went under. So I think there is increasing risk within the banking sector, but it's not by banks increasing their credit lending. It has been by shifting from what they perceive as risk into lower risk. And this is actually something which they're encouraged to do by the regulators. I mean, the regulators laid down exactly, and under Basel III, you look at net stable funding ratio and all the rest of it, and how this is all made up. What you basically do is you lend to the government less than 1 year, and that way, you have the cleanest possible balance sheet. From a risk point of view. Anything else? Whoa, this is not nice. So the regulators, if you like, work in favor of the governments, and they work against the private sectors. And they also work against the private sector in a different way. They encourage banks to group themselves into large groupings so that local lending doesn't really happen anymore. I mean, I don't know about in America, but I know in this country, if you're running let's say a business employing few hundred people in a town like Exeter, which is down the road, and you want overdraft facilities, it's not decided by someone locally, if you like, a bank manager locally who knows his way around the local economy. No, it's all centralized back in London. And the answer is computers say no. So banks, in that sense, are not providing the service which they should be providing around the nation. And I'm sure that this is the same thing in America.
So what you're describing there sounds like yet another example where what banks are doing is investing in a non-productive economy of just sticking money on deposit at the Fed. And that in itself, that very action, as they are incentivized to do, is going to increase the chances of a recession. Is going to put pain on small and medium-sized businesses and individuals.
Yeah, exactly. Because I mean, from a banker's point of view, if you see deteriorating economic conditions, then that equals risk. So how do you cover that risk? Well, you need a higher return. And then you sort of think, okay, if this company which Dunigan Kaiser is running, isn't really all that profitable, will it bear a higher interest rate? The answer is no. So we want our money back. Thank you very much. So you can see how this is actually how the credit cycle works. And the problem that we've had is that really since about the mid 1980s, every credit cycle, the Fed and the Bank of England and the Bank of Japan, whatever, and the predecessors of the ECB have jumped in and stopped the liquidation, if you like, of bad businesses which have unproductive loans, the zombies. Good political reasons, but very bad economic reasons. The result is that, all the distortions of a credit cycle just get wound up into the next credit cycle. And you don't necessarily see the cycle in terms of, money supply because, it sort of constantly increases as a result of this. But what you end up with is an absolute mountain of bad debt. And I mean, we know this. If you look at the debt side of everything, I mean, the amount of unprotected debt is huge. And of course, you get people who play the cycle and get it incredibly wrong. The private equity industry in this country is a very good example. When you had Thames Water, which is one of our largest utility, it serves the whole of London and surrounds. Very big company. Now, the water industry is regulated. We've got a regulator, and the regulator tells the water companies, how much money they can make and how much money they've got to invest in, in terms of their infrastructure and all the rest of it. But it's a wonderful business because the regulator basically says, we will calculate what you have to do so that you make a return for your shareholders of 8%. Okay? So you've got a utility 8%, guaranteed by the regulator, in effect. Now, it wasn't meant to be like that, but that's actually the way it works. So you get private equity businesses from America or wherever who look at this and think, this is something we can leverage up. And particularly when interest rates drop to zero, I mean, hooray! We can really leverage this up. So, you can turn an 8% return leverage 5 times into a 40% annual return for the private equity boys. I mean, lovely stuff. Until you got to refinance it. And of course, what happened was that interest rates rose. Nobody expected it, but interest rates rose, and suddenly Thames Water is bust. And we've got this, that's what's happening. And it's happening around the world, not just Thames Water, but I mean, it was the consequence of earlier suppression of interest rates by the central banks. So what do you do now? Do you lend money to Thames Water? I mean, you say, Thames Water might approach you as a banker and you'll say, well, we're not too sure about this. What government guarantees can you obtain? Then we might consider it. I mean, the whole thing is an absolute mess. And the underlying point is there is so much zombie debt within the private sector that higher interest rates, which are inevitable now, are going to drive the whole economy under. This is why it's so dangerous at this juncture, at the top of the credit bubble, to have trade tariffs coming in, as they did in 1929, 1930. Smoot-Hawley Mark II. That's what I call Trump's, beautiful word. I really do see that. I mean, it's a disaster. It is a disaster in the making.
When you warn individuals to get out of credit, one of the things that I imagine might be on your mind is something that most people aren't aware of, but it did happen back in the 1929 through 1933, the Great Depression, and that is the calling of loans. In other words, banks so intent on protecting themselves that if they perceive increased risk on the part of a borrower who has a mortgage on a farm or on a small business or on a home or whatever. I mean, my wife and I were applying for a home equity line of credit about a decade ago, and I read the fine print and the fine print and the fine print. And in the fine print, it said, like, if either of us were to pass away, for example, if there was any change in our credit worthiness or income or whatever, the bank could immediately say, okay, that's not what we signed up for, and say the loan is due in full and due now, rather than on the terms that had originally been agreed to. So this must be another reason that you're advising people to reduce their own risk posture by not falling for this, their own personal debt trap that so many nations are getting themselves into.
Yeah, there are two levels of this, obviously. I mean, the one is the investor level. Is usually people talk to me, they're trying to protect their wealth or preserve their wealth. And the answer is quite simple: get out of credit. But then you've got a problem that, they're used to, diversifying their portfolio. So the idea of putting everything into gold or gold and silver or whatever, is completely alien to them. It really is. But I still say, look, get out of credit. But again, you've got the problem that no compliance officer is going to sanction that for a start. Everything that is if you like, a regulated investment is actually credit. So this is complete denial of the existing system as far as the establishment is concerned. But you're right to point out there is this other side of it, and that is that you've got debt in the form of mortgages. Most people have got this. And it's a question of how they handle that. Now, I would say that in a real credit crisis, it's the banks that got the problem rather than you've got the problem. That's the first thing. But it's something that you could probably manage if you make sure that communications from the bank are answered, that you appear proactive. What that means, I think, is, and I don't guarantee this, but I think what it means is that in terms of lender psychology, if somebody is, seeming to be quite helpful and understands the problem and all the rest of it, that, as far as the lender is concerned, is less of a problem than someone who just ignores your correspondence or is rude or whatever. Those are the guys who are going to get foreclosed first. And as well as that, of course, everything is so political. I think that the political class will tell the central banks to tell the commercial banks, do not foreclose on unfortunate people who, have got to have a roof over their heads, as it were. So that, I think, is another line of defense. But of course, if you're investing in property, or if, let us say, you are living in a bigger house than your circumstances warrant, then you are exposed to a real problem. You're going to end up with big negative equity, even if you manage to play the game a little bit to persuade your lender not to foreclose on you, but to foreclose on someone else before you. I mean, it's not going to be a happy situation, but you've got to have a roof over your head. So, you're probably stuck with a mortgage where you are. Just don't, I think. Actually, I mustn't wander into giving advice on this sort of matter. But I think it would be absolute folly to if you like, try and take advantage of falling property prices to leverage up your position. I mean, there will come a time when you could do it, but that will be very close to the final collapse of the currency, not while it is still going down. Because as it's going down, interest rates will rise. I mean, if you think it's crazy that interest rates will rise while the economy is in such a mess. Just imagine that you were in Germany in 1922, 1923, when the mark was collapsing. What sort of interest rate do you think existed? It was probably a lot less than warranted by the collapse. But, if you're going to borrow anything, I mean, you are going to pay very, very high interest rates. Because it's the only way in which you'd be able to obtain any currency. And indeed, people made fortunes doing that. We had Hugo Stinnes, the inflation king, who founded all sorts of companies and one stage owned roughly 25% of Germany in terms of productive assets. He, unfortunately for him, died on the operating table in 1924. So he didn't live long enough to enjoy his fabulous empire that he had assembled.
Alasdair, you write on these topics on a multi-times per week basis. I keep seeing these tantalizing headlines come out from your Substack. Can you tell people how they can find you on Substack and what they'll get if they decide to subscribe?
Yeah, Macleod Finance, or the Substack address is actually alasdairmacleod.substack.com. And I feel I've got a mission to educate people about the dangers of the current situation, and to explain why it is that gold and silver appear to be rising, and to explain that actually what's happening is their currencies are declining in measured, if you like, in gold and silver, and also to explain in as if you like as simple terms as possible the economic drivers that we see, and to understand that, and to also to understand how geopolitics affects the whole thing. It's quite a wide brief, but I just want as many people as possible to be protected from the dangers that I see. And that's where this sort of interview I find is so valuable, because it just introduces people to, it makes them sort of think, we need to understand this. And yes, you do need to understand it. And I think that's the important point.
And I'll put all of that in a nutshell. The emperor has no clothes on. So thank you for shouting that once every month or so on our channel. We appreciate that eye-opening statement in all of its then corroborating complexity as you try to explain to us the underlying fundamentals that are driving that. Thank you, Alasdair, for joining us here again on Liberty and Finance.
That was my pleasure, DK.
This is Kaiser Johnson with Liberty and Finance. With premiums on US 90% silver constitutional coinage at multi-year lows, this may be an ideal time to swap silver bars or rounds for 90% silver and gain all the benefits of US mint lineage, legal tender status, non-reportability, and fractional utility. So right now we're running a special where we will swap any of your silver bars or rounds for 90% constitutional silver at a minimal premium difference. Call us for details.